Hey everybody, welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I am your host, Dr. Michael LoPiano. Welcome back. It's great to see you. Great to see you on a Christmas Eve and an upcoming half day in the market, right? This is a reminder that trading will close at 1 p.m. Eastern time today. So looking forward to hopefully something that doesn't look quite like the last time we had a half day. You'll recall that about 4 weeks ago, just after Thanksgiving, was the big reversal we had after something like approximately 4 weeks of unmitigated bull run. This was the beginning of a 4 to 5 day downtrend in GameStop that was only finally reversed at around the time, really precisely at the time that Roaring Kitty posted his Time U cover post on X. Whether that was an actual response to him or something else happening in the background, we can't say. We don't have enough information, but right, hopefully we're not looking at something similar here with a reversal of on the magnitude of something like what we saw after Thanksgiving. So really, contextually, I'll state first off and overall that we're not really looking at the same sorts of conditions, though it's still helpful, it's still useful, it's always useful to take a look at our data and look at what sort of contexts across multiple levels we're in and what that can tell us about how we might be moving, transitioning, or potentially being trapped for something like another retracement in the days to come on this short week. So we're going to break some of that down today. I'm going to break some of that down today as we take a look at today's analysis. For those of you who may be joining us for the first time today, if you'd like to go ahead and look at how I lay this out every day, every trading day, I should say, I post daily GME analytical articles taking a look at technicals and options data over on X. If you're watching this video on X, you can find that pinned right at the top of the page. If you are watching this on YouTube, then you can find the article link down in the description. Okay, let's get to it. So the title of today's article is indeed Transition or Trap. So market makers, are we moving into a situation where market makers are preparing to transition into a new trading range, or are they potentially setting us up for a reversal, a retrace, perhaps not as deeply, but still of the same sort of character that we saw about a month ago following Thanksgiving? So really, to a certain extent, I will say that both of these options are on the table for this week, though looking at historicals, looking at our technical setup, we are set up a little bit differently this time around Christmas versus what we were looking at back in Thanksgiving. So, right, the big question back in 2020 during the first big run-up, this upward volatility event in January of 2021 was, in late 2020, is GameStop going to close above a pre-split adjusted $20? This time around, is GameStop going to close for the first time in 2.5 years at a post-split adjusted $30? Is that what's going to happen, right? So we're looking at a price difference something like 500% since then. Interesting to consider for those of you maybe who have been in this saga or around some of this going back all the way to 2020. Curious to think about where our price is now and kind of reflect back on what that meant then. So, right, beginning with taking a look at what we saw yesterday, indeed, this test of our lower bounded support in our macro bullish channel, this regression channel that has been forming up that we've been trading within since the 28th and 29th of October, the VW squeeze anniversary, and the National Cat Day catalyst, filing of Roaring Kitty's 13G announcing his departure from his Chewy position back at that time. Right, we've been trading within a macro regression channel that's bound bound our trading and framed our trading since then. Of course, it's transformed a bit and it's taken slightly different shapes as we've moved across that time period, but by and large, it's stayed pretty much intact versus what we saw right back in, say, mid-November or even late November. So what we saw yesterday, right on Friday, we got that test pre-market of 28, like I outlined in yesterday's video, that test of that lower bound of our bullish regression channel on our 4-hour chart. And we continued after what was a significant amount of very large dark pool orders. I did go back and look at the order codes on a lot of those major orders that I outlined yesterday. If you remember from yesterday's article, from yesterday's video, I speculated based on the way that this price movement looked during Friday that it was something of a VWAP order, a volume weighted average price order. So when brokers have to settle very large orders, they will punch them through a VWAP order. So they will have that order broken up into small trades, which is processed at the volume weighted average price. So they will put these orders in, the shares will be acquired over time, right? They don't all go in at once. But what that looks like is this pretty gradual scrub kind of up to the right, right? You'll see something like that if it's buying, wherein usually it'll be underpinned by a moving average. Something like what we saw on Friday was the 20-minute moving average intraday, and that order began at the volume weighted average price. So when those orders were punched in, they were punched in while the price was hovering around the volume weighted average price. So it came to around 3 or 4 million shares that looked like they were processed. They were finally settled. That order was finally logged at the close, or it got an extended hours code, something like that. Maybe some of it went into the after hours. Maybe market makers processed that order up to a certain point, then paused in order to walk the price down sub 30 to 29.80. Was it 29.82? Yes. In my video, I said it was 29.92. 29.82 was our closing price. So that was our options print. And then it looked like some of that may have been continued into the after hours, where we traded up to about $30.25. So those were orders that were assessed at the average price. So those were assessed at the volume weighted average price. We got a very little bit of that yesterday. There was an order of about 33,000 shares that did something like that, right? But by and large, this was just being driven from the looks of it. Maybe there was some settlement stuff that was held over. Maybe there was some option settlement stuff, some options delivery obligation stuff that was held over from Friday. I'm not sure, but this was in general a lower volume day, not a crazy low volume day, right? When we start seeing things like 5 million, 6 million, that's pretty low, right? We see that. We see a lot of hesitation, let's say, from the options market. Uncertainty on more uncertain days, that's the kind of volume we've seen within our current bull trend. We didn't see those levels of hesitation or uncertainty, but things were definitely of a lower volume. I think we got about 8.2 million shares, which is around average traded for the day. If you take our average across that period, it's about 8.5 million, something like that. So we had something of an average day, but it was decidedly bullish. We were shifted toward bullish premiums, bullish trades in the options market. A majority of the money went over, slightly under a majority, a large plurality, a healthy plurality went towards bullish trades. And right, we saw very stable trading up through this call gamma dominant bracket above 30. $30 served as a call wall. We got some pretty quick tests to try to dip the price below 30 that reversed very quickly. So this early in the week, while delta values on out-of-the-money contracts are still high, while charm is not really setting in to damage the delta values of those out-of-the-money contracts too significantly, market makers are not necessarily at liberty or willing to separate themselves from hedges for contract positions, for call OI positions that are significantly out of the money at this point. So that being said, something like a call wall, a weekly call wall that has a lot of built up gamma around it, is going to act more strongly earlier in the week versus later in the week when market makers may choose to allow themselves, right, to calculate, okay, well, if we let these hedges go now, even though some of these contracts are only barely out of the money, we can let them go now. It'll let the price fall below certain key levels, and then we won't have to buy them back because then these options will expire. Or if we do, we can buy them back. So our price moved up pretty gradually throughout the day, right? We used $30 as a low. We also did this trading right atop this, roughly we tracked along the 200-minute moving average as a lower threshold, as a dynamic threshold throughout the day. And then any attempts to move above what was a confluence of the midline of our bullish regression channel at 31 and the upper sort of resistance level of what had been this sort of bearish regression subchannel, which since transformed into something more range bound and now is mostly just, it looks like it's conforming now. It is aligning pretty closely with the lower half of our bullish regression channel overall. And if we go ahead and take a look at our 4-hour chart, we can see that, right? The more we move into this range bound, what formerly range bound regression channel, right, our price more or less conforms with the lower bracket here, the lower half of our bullish regression channel, this sort of macro bull trend. So where we're set up now is, yeah, we might break up, right? We could potentially break out and into this upper channel. RSI is certainly permissive of that. We're not sending any, we're still kind of relatively neutral on the channel. I think probably pre-market now we're pushing up to maybe about 60 on RSI, something like that. Yeah, pre-market has us a few cents over this line. Right? We might trade up here. We could go into this sort of more bullish scenario. We are set up in the options data to trade up into this area. We could potentially do that. We've got something like over the next couple of days, 33 to 33.50, something like that on the approach to this. Right? We have this as an upper resistance line, the top of our bull channel around 33.50, with the coincidence of 34 as a historical resistance level. I could see something of a bullish breakout scenario heading up toward that level and then deflecting pretty hard. That could take place. Again, as we'll look at our gamma data in a second, we do see that potential emerging. But we could also kind of go flat into the close here, sort of ping pong in this little tight area if volume's not high. What it does look like from our options data, although I'm always wary of how market makers will attempt to nudge the price in order to optimize their bottom line, in order to optimize their profitability by driving the maximum amount of options contracts out of the money. That is principally how they profit from their position as a dealer. Why I am wary of a potential $30 close, even though right, we do have some room to run to the upside, is in our broader market context. This is something that Spock Gamma has been writing about very recently. In our broader market context, we do have something of a false sense of security in that Spock Gamma has pointed out, okay, 6,000, this level in SPX, SPY around something like 600. This was a pretty critical support for the continuation of the bull trend we've been in SPY since the results of the election, which have more or less lined up with GameStop's bull run, right within a few days. Although GameStop's actually looking a bit better than the overall market based on how we responded in GameStop to the Fed announcement last week versus SPY. So GameStop in particular has not lost its supported, especially its options supported position overall. In fact, into this week, we've claimed a position, we've taken and held this breach of the $30 call wall, which is serving as a strong underneath support. GameStop is in a much stronger options structural framework with respect to market maker gamma exposure versus SPY, right? SPY, the S&P 500 has crossed this critical support level at 6,000 and it triggered this massive amount of volatility, this downside volatility, and that although right now it's being picked back up, right, the distance that it fell below 6,000 is being picked back up. SPY still has not reclaimed that 6,000 level. I should say SPX still has not reclaimed that 6,000 level. And in fact, toward the end of last week, used it as an upside resistance. So that's not a great sign in the broader market as far as immediate stability. There may be some more, I mean, it doesn't necessarily say everything's going to fall apart, but there is still some potential for some kind of whipsawing and slipperiness while we're trading in SPY below that threshold. So that may be used, right? We may be going through this, quote unquote Santa rally, which is something of a false recovery, unless SPY really definitively reclaims that call wall support, unless SPX can move over that 6,000 threshold and hold position within that threshold, consolidate above it, then we do still have potential for volatility while we're trading in that, well, I should say anything below 6,000, right? Okay, so there's something, I think 580/5800 is where, or I think it's 5850 is where SPX has its put wall. Maybe it's low. I mean, SPX maybe 5800. But right, so this is our sort of broader overall context. And this could be used just like the breach of that call wall last week with the Fed announcement was used as an excuse to build some bearish momentum for a reversal for a correction in GameStop itself. The failure of the Santa rally to reclaim 6,000 in SPX may be used as a similar excuse to bring us back down to about 30 or finish below 30 for this week. Certainly, technically, that's still permitted, right? The lower half of our lower channel is still below $30. So a close in this area, a close right down around, say, where the 104-hour moving average is, that would not be technically critical in the sense that it would not jeopardize the overall structure of our bull trend. It wouldn't be something crazy violent that would require a heavy amount of interventive shorting. There are still 900,000 shares available for loan. These can be deployed tactically by institutions to circumvent potential supports, to undermine supports within the structure of the options market. This can happen. That being said, we do have some signs that are popping up in our OI data and in our gamma exposure, market maker gamma exposure, that do suggest that market makers may be putting us in a position to transition to a new trading bracket. So just like what we saw around the crossing of the $25 threshold, where GameStop moved into a $25 to $30 trading bracket, we're seeing some of those same types of adjustments in the OI and in the gamma data, the gamma exposure data, that look like market makers are preparing us to transition into this new bracket. Now, why do I say transition? When I say transition, I mean to have something like a new call wall. So, right, the call wall tends to serve as, on the one hand, a psychological target for bullish or bearish sentiment, judging on the overall trend. We're currently in a bullish macro trend, so that call wall is going to serve and is serving and has served as a psychological target for options traders, in particular traders that like to use round psychological numbers. Right, less experienced traders, or traders who are trying to sort of get an idea of kind of mass sentiment, something like that. It's not even less experienced traders. Round numbers in general, traders, whether they're more experienced, less experienced, what have you, tend to target these round numbers. And it's sort of like a self-fulfilling kind of navigable mark as well, right? Because the psychological round number, 30, 40, 35, 25, something like that, not only is that an easy number, a round psychological number for traders to target, but then because a lot of traders are targeting that strike, it narrows the bid-ask spread. So you'll very often notice, you've noticed like, okay, why is there so much OI at $30? In part, this is because there's so much volume at that strike that it makes it a very popular contract to trade. Traders, more experienced traders, will target contracts that have a tight bid-ask spread. This is part of the reason why you don't see a lot of activity at the $half strikes. They're not popularly traded, and then it has this kind of negative reinforcement element where it's like, well, they're not popularly traded, so the bid-ask spread is bad. So traders don't trade it because the bid-ask spread is bad, so it's not popular, right? So that's sort of the inverse there. With something like $30, very tight bid-ask spread makes it a popular strike for scalpers, for day traders to use because of how it's just easier to profit from flipping that contract. If you've got a 7-cent spread, like that's very difficult, right? You need a bigger movement in the underlying in order to potentially profit from that contract. Whereas if the bid-ask spread is a cent or two, you can profit, right? You can scale your position pretty large and profit meaningfully from, a smaller movement in the underlying, right? If you get, if the contract is valued at something like, 40 cents and you get, I don't know, an 8 cent, you can get 8 cents in it, right? You can get a movement in the underlying that causes an 8 cent appreciation. That's a 20% profit, right? And you may only need something like a quick, 40 or 50 cent move in the underlying during the day in order to take advantage of that type of trade. So scalpers, day traders are gonna like that. But if that 8 cent move that they're targeting is entirely mapped by the bid-ask spread, then that type of move is going to be obscured. It's the appreciation of the underlying contract is going to be obscured, and it's going to be very dependent on how good of a fill they can get, and if the market maker, if the broker, whoever the designated market maker is willing to come and meet them at a good order. So it's way tougher. So they tend not to target those. Okay, so right. So call walls tend to function as the psychological target, as an overhead target, and what that means too is the designated market maker can also use that as an opportunity, right? They can use that to accumulate a large amount of open interest, particularly call open interest, given our bull trend, that then expires out of the money, right? They can draw in traders at that round psychological strike that's decently out of the money. Oh, what do you mean? Like, we're trading at 32 or 33, 35. Oh, it's right there, right? Just like, oh, we're trading at 28, 29, 30. It's right there, right? It seems like it's really close because of the numerical distance in the number, right? But that doesn't take into account market maker hedging. It doesn't take into account gamma exposure. It doesn't take into account technicals. It doesn't take into account consolidation or relative strength or volume. It doesn't take any of those things into account, right? The distance between those representative integers does not correspond with the underlying reality of what sort of value exchanges need to occur, not even just insofar as the movement is concerned, but structurally, in order for a particular price threshold to be retained within the context of our overall trading. So psychological numbers, just looking at a representative integer, does not take that into account. So that's a big issue that traders often face, right? Especially newer traders, retail traders. That's a very common trap that they will end up falling prey to. I myself did, right? When I started, I made all kinds of mistakes when I was trading. Oh my gosh, only do long calls, only do long puts. Oh, look at just do this kind of out of the money psychological strike because the liquidity's good, and I'll just hold and hope it works. And it's like, that exactly right. A lot of this is structured. This game is structured for that specific pattern of thought to result in profitability for designated market makers, for dealers. That's why that's built into the structure of the game. Let's say that. So, okay, what does that have to do with our current situation? What does that have to do? What am I seeing here that would suggest that, okay, maybe something structurally is changing such that $30 would be something or could be something that market makers would accommodate for a weekly close? So let's take a look first at our OI data here before we get into our gamma exposure. And what we see is, okay, I mentioned this yesterday. $30, number one, although it is a large open interest position, it's not a crazy high open interest position. Last week, midweek, we saw something like 27,000 open contracts at this strike, and a few thousand at some strikes above it, maybe 3,000 or 4,000 at 31, 32. Okay, that type of structure heavily incentivizes, or I suppose relative to what we're looking at now, heavily incentivizes market makers to make sure to invest money in nudging the price such that we close below 30. That's a lot of contracts. Even by the end of the week, we still had over 20,000 open contracts at $30. That, could correspond, if that closed in the money, right? You're looking at something like would that be 6 million delta, something like that? No. It'd be 2 million. It'd be like 2 million delta that they would have to go out. They'd have to go get 2 million shares to deliver on those obligations. That would be a lot of buying, right? So like Friday comes, and let's say the delta when the market opens on those contracts is something like 0.2 or 0.15, right? Okay, they're hedged, but they're not hedged crazy on those 20,000 contracts. But then, price action takes those in the money. If there's like an hour or so to go, they can just go like, oh, you know what? We're not going to hedge these right now. Okay, we're not going to dynamically hedge these contracts because we're going to allocate resources maybe to shorting the stock or, something similar. Maybe we'll do something with IV so that it can encourage some sale so that it will disproportionately allow the price to kind of collapse a little bit. So we know that it'll close out of the money, right? We know $30 will close out of the money if we take these measures. Therefore, we don't have to hedge them. Therefore, we don't have to deliver on those. Therefore, okay, we don't have to do that type of buying. We don't have to actually, we can just collect all of the premium on those strikes. That's all going to go straight into our pockets. Okay. So, but this week, we started off the week with a little over 10,000. Right? Still big, but not crazy. But because today, early in the week, we were already trading above $30, basically for the entirety of yesterday's trading day. We only got 700 more contracts at this strike. So $30, although it's a big position, it hasn't increased very much. Now, if we look up the chain, right, we see significant new accumulations at 30.5, right, 30.50. 31 is now approaching, 31 and 32 are approaching call gamma, call OI accumulations that are close to 30. There are a lot of calls that are being opened in this area, right? Look, almost 3,700 were open at 32 yesterday. We have calls being accumulated at 33, at 34, at 35, right? 35 is now very close to 30 in terms of its overall call OI, which means it is forming up as an overhead target. It is forming up as a potential future candidate for an overhead resistance call wall. We also have now our largest OI, our largest call OI position for this week is now not 30. Okay, it's not 35, 30 is still big, but it's now 40. Okay, so we have a lot of activity going on at strikes above 30. So this makes it slightly less unattractive for market makers to allow 30 to close in the money. Or if it does close in the money, right, it doesn't have to close hugely in the money. It can close at 30.20 or 30.15 or something, and that's not going to result in huge premium losses. But if we can see this pattern continue, where trading remains up above 30 and activity concentrates in this range, then market makers will remain sufficiently profitable by allowing the price they could allow the price to close above 30 in the sense that they may be disincentivized from taking emergency interventive maneuvers, from nudging the price so that it closes once again below 30. Now, that doesn't mean they're going to let it close at 33 or 32 or 31, but a $30 close, a slightly higher close is possible, is more palatable versus what we've seen in prior weeks because of this. Another element, we don't have much OI below 30, right? So there's not this, there's a disproportionate amount of, say, put OI that is, that has accumulated, right? They don't gain much by pushing it like way down. There could, right? Things can transform, but they get most of the benefits. Again, they get a huge profitability advantage. Right now, it probably looks like it's somewhere around 29.5. So again, a similar, right? That would be maximal. But if we can get a lot of top heavy OI, maybe if some people can take OI, right? If traders take profits today out of that, right? If they close some $30 positions, that might end up being that might increase the odds that we close above that level. Again, I'm not saying it's necessarily going to happen. I myself am still wary that we could get an end of the week close at, once again back at like 29.80 or something. It's worth keeping in mind, but the conditions are a little bit better suited for something like that to take place. Now, if we go ahead and look at our gamma exposure, right, we can kind of see that lining up. We're just not seeing, right, market maker gamma exposure is all concentrated up in this 30 to 33 area. So what this says is, right, traders are not trading really in this area below. We're not seeing very much new put OI come on the board. When it is, it's pretty light. It's still offset by call gamma exposure. There's not a lot, I guess, in the immediate term, right? Like for today's trading, that suggests that we would trade outside of this $30 to $33 area. And I can even look at what we're doing right now in the stock price. Yeah, how about that, right? Shot up to 31.54, kind of right off the open there. Pretty cool, right? Maybe we go back higher, who knows? But we're kind of squarely moving into this area. We traded up slowly into this. And what this says is, this is very supported. This is low volatility. This is the sort of environment that gives the impression of stability, that gives the impression of downside support, that gives the impression that, it is safe to come in and gamble on long calls, right? That this type of environment, slow, grindy, slightly moving up with some pops, kind of to the upside, like we saw right off the open up to 31.50 there. This is the type of environment that gives a sense of safety in the purchasing of these bets, right? Of course, this can always change, and very often too, we'll see this kind of put gamma accumulate in the background sometimes when we're about to kind of break our stable trading grasp, right? Something like that occurred last week, especially on SPY SPX, with this break of that $6,600 call wall support to the downside. So we don't have those conditions, right? We're not in that unstable environment like we were with like SPY is right, still even right now. So why is this something that might work to dealer or market maker advantage? Well, if we have these stable conditions, if it looks like it's safe to come in and just purchase long calls, and we're going to get this slow grind up, right? Less experienced traders, maybe who haven't seen, okay, well, here's what can happen, that don't take into these sort of paradigm shifts or structural breakdowns, don't account for the possibility or the contexts under which that stability can break down, then, right, it may draw them into target 35 as an overhead number, right? Because they would see, oh, well, if we just kind of keep going up $1 a day, right? We just keep grinding. They won't necessarily take into account the fact that between $33 and $35, we have a hedging dead zone, in that this is not buoyed. This is not, our price movement is not encouraged or supported by the same level of kind of gamma hedging tailwind as the price moves up. So basically, so it's something, it works like this, right? In a static environment where no new calls are coming on the board, call gamma in general is volatility suppressant. So imagine a static environment. You have this gamma on the board. As the price moves around, right? Let's assume no new OI is coming on, right? The price is just moving around. Shares are being bought and sold by the lit market, and no new options are coming on the board. Okay. As the price goes up, dealers are going to sell gamma hedges. Okay, as the price moves toward high levels of call accumulation, dealers are going to sell gamma hedges because that hedge is in place to hedge the potential for change in delta. It hedges these situations where delta will change rapidly. As contracts go into the money, as you get close to them, and as they go into the money, the rate of change of delta is highest. And as they go into the money and as you move away from them, the rate of change is slower because, right, it's something like, you only have 100 points of delta, let's say, for a particular contract. And as you get on the other side of 50, right, as you approach 50, right, you'll go from, okay, right, that's, kind of exponentially increase. I imagine it follows it looks something like a normal distribution, like a bell curve, where, you go, okay, as you approach, then the rate of delta change goes up and it spikes and then it comes down, right? So it's like, right, pretty even. It looks like a bell curve. So now let's say, though, you're buying lots of calls. So new contracts are coming on the board. New call OI is being opened. As those calls come on the board, they are sending contracts, they are sending other static contracts into the money. And so dealers not only will hedge bullishly, right? As you buy a call, they will buy points, they will buy shares to hedge their delta and gamma exposure on the new call, but you're pushing out of the money contracts into the money, which is causing dealers to go out and then purchase shares in order to hedge their gamma and delta exposure on those contracts that are already open. So you get this tailwind. And so it'll proceed at a certain pace, higher and higher and higher, until you reach hedging dead zones where, okay, now when you buy, let's see, now the price is 30.50, you're like, oh, well, it'll just move up like it was when it was 31.50 or 32.50 or whatever, right? But now let's see, when you're buying a contract at 35 or 34 or what have you, you don't have this same amount of gamma exposure at 33.50 that you did at 33 or you did at 32. So each contract that you buy is stimulating less bullish market maker hedging relative to the level of gamma exposure than it was at lower strikes. So what happens is it slows. That tailwind is not as strong, it's not as prevalent. You reach a hedging dead zone. And traders, more experienced traders, will see this change and go, okay, now I can flip back to the other side and take advantage of that gamma exposure going back in the other direction. And I can benefit from a momentum change as now dealers separate from their long hedges on bearish momentum with respect to gamma exposure. So, right, this is important to take into account. Many retail traders, even many experienced traders, do not necessarily take this into account. And this isn't necessarily apparent just from looking at OI data in general. You can guess it, right? Once you know that gamma hedging, that gamma exposure dynamic is in place, you can sort of guess that. You can get a sense of it roughly, less accurately than by looking at a gamma exposure chart or gamma exposure levels. You can get a sense of that by looking at the OI data. But if you don't know that market makers behave that way toward delta and gamma exposure, then you don't necessarily know that that's going on. You won't necessarily be able to spot these kind of hedging dead zones. So, right, if we do move up into this area, that's going to be a pretty strong reversal signal, right? Doesn't necessarily mean we finish below 30, but that'll be a pretty strong reversal signal. I'd imagine we'd see something like IV spike, just like we saw on that decent pop there. Did we get an IV spike? A little bit, not really. But IV would hypothetically pop up a little higher, and it would certainly be higher than it would be if we reverse to the downside. Let's say something like that. So you get some IV crush, you get some delta crush. These contracts go out of the money. Market makers are happy because they suckered in all this new call OI, thinking that, oh, wow, we're at 31, now we're at 32, now we're at 33. But then, there's that hedging dead zone, right? Everybody else thought, those inexperienced traders thought, well, of course, why wouldn't we just go to 34? If I just keep buying calls, like, oh, we're just going to keep going up. That's what we saw just prior to Thanksgiving. So maybe we see something like that. Maybe we see a particularly bullish day. We move into 32. We kind of test this upper limit. Maybe we even come out hot on Thursday with a 33 test. But then we get a little market instability. We get some sell signals on the RSI, right? RSI is showing something like overbought. More experienced traders start to put in some bearish trades. they themselves start mimicking dealer strategies, which allows dealers to go ahead and sell to short shares to match that now their long gamma exposure. So yeah, that's possible, right? That's possible to happen. I could see that taking place. It is always important to certainly I always reflect on this and think, okay, where could I find reversal points? What is going to signal a reversal to the broader market, technically in the options market, right? Again, technically, this area, this 33 to 34 area, that lines up with the upper bound of our current bullish regression channel. So we have once again, right, looking at this from multiple angles, we have a confluence, we have an alignment of multiple data areas, right? Multiple points of navigation are lining up around similar price levels. I mean, they also are sort of reflective of people interpreting each other, right? Traders interpreting each other there. So that's possible. Now, like I said, it does look like we've got the best chance for a bullish close, the best chance we've had in really in like 2.5 years. This is the best context that I've seen that would enable something like a $30 close. So maybe we have something like, maybe it's not a question of one or the other. Maybe it's like dealers do see in the next couple weeks, there's going to need to, right? I outlined this yesterday. In the next couple weeks, it does look like there will have to be a transition into a new bracket. That's sort of transitioning into a $30 to $35 bracket within the next 2 weeks in those first couple weeks of the new year is the path of least resistance. It requires the least amount of interventive nudging in order to permit, let's say, that kind of optimal dealer profitability. And they may be taking this as an opportunity to allow that to take place. They may have seen this amount of bullish buying from, let's say, these are ETF rebalances or funds or something like that, whoever was responsible for buying those 3.5 to 4 million shares on Friday. Maybe they're reflecting on that and saying, okay, this is as good a time as any to kind of allow that transition so that now we can profit off of $35 and $40 and kind of that stable trading in the 30 to 35 range, just like we were profiting off of that stable trading in the $25 to $30 range, right? So now they might be letting that happen now on their terms, but they might also be setting this up for, hey, in case the market kind of dips a little bit, we could potentially take advantage of that to get one more, two more, something like that, expiries with $30 out of the money. So that's how I'm thinking about this. I'm being careful heading into the half day today. Like I said, I think in the immediate term, we are looking today at some stable trading. Right, we're already seeing this. Right, this is how we open. This is what I outlined in the article. We're trading in these more stable ranges. Especially early in the week, this dense 30 to 33 high call gamma exposure accumulation area is very volatility suppressant for our trading. Later in the week, maybe we might see something of a retrace, depends on how high we get up today. Maybe we see some more bullishness on Thursday. We'll have to see really what trading looks like today. But in any case, right, as always, this is not financial advice. This is not trading advice. This is for education and entertainment purposes only. And I hope on this Christmas Eve, you have a chance to share some of that, share some of the holiday spirit, let's say, with your families, to enjoy what has been, to reflect on what has been a wonderful year, certainly a wonderful year as I've gotten started working on this regular publication and talking about my analysis here. So thanks to all of you. Much love to all of you and your families. Thank you for all of your support, for continuing to watch, listen, like, comment, share, all those things. So thank you very much. Have a wonderful Christmas Eve. Have a wonderful holiday season. And we will see you all on Thursday. Market is closed tomorrow. So thanks very much, everyone. We'll see you next time.